Hi everyone, in this video lecture series we are going to start talking about accounting. In this particular video I'm going to give you an overview, and in the subsequent videos I'm going to show you specifically how transactions are recorded. Transactions are the building blocks of accounting, and we are going to pay specific attention to that. So let's, in this again, as I mentioned in this video, we are going to have a broad overview. Let's start with the information on company's activities. No matter what the company does, whether it's a service company or a startup or a production company, it needs to be able to collect information on its activities. The information is used in several ways. There are four important ways that the company uses this type of financial information. One is planning, which is deciding on what to make and how to make it. The other one is financing, um, how the companies are going to raise money. Are they going to borrow money from the bank? Are they going, if it's a public company, are they going to issue bonds, or are they going to issue equity, which is stocks, or are they going to have more partners to participate in the company? The other one is investing, which is buying with the money that's coming from financing in order to best do the business. It can be buying machinery, it can be buying servers, etc. That part is investing. And the last part is operating, which is how to use the things that the company buys in order to do the best way to conduct the business. That's the operating part. A lot of different stakeholders use financial information differently. Um, there are six main categories. Number one is obviously the managers and employees. Within the company, they look at the financials to see if they are doing a good job or bad job in terms of what's selling, what's not selling, which geography are they more profitable, which geography are they not. Those types of things come into play when they look at companies' overall performance. And another example is, the marketing department can come up with a marketing budget, and the question is, can the company afford it actually? If you join a startup, or if you build a startup, the question is the company run well? Do we have enough cash to cover the expenses, etc.? The second part is investment analysts and intermediaries, especially for public companies that are traded, the shares are traded on public exchanges. Should the analysts, the investment bankers recommend the clients to buy the shares of the company? Is the company doing good or poorly? What's the economic environment, etc.? So that's the second group, the investors. And then there are creditors and suppliers. Creditors, obviously, their main question is when they lend the money, the question is the company able to pay the money back? Or for the suppliers, since they typically work on credit, which is, they supply the goods and services, and after a while they collect the money, should they make the custom parts? Should they invest in making the custom parts that the company is requiring? Um, so that's the third set of the stakeholders. The fourth one is the stakeholders and the directors. Stockholders specifically, they are looking to see if the company is run well. Needless to say, if the company is run well, the stock price is going to increase. That's in the interest of the stockholders. Not only that, but the net income is going to increase. Overall income of the profit of the company is going to increase. As a result of that, they can get dividends. So that's the main goal of the stockholders. And the directors as well is the CEO, the chief executive officer, doing a good job in terms of running the company. And then there are customers and strategic partners. When you buy especially a longer term asset, from customers perspective, is the company going to be around for another 5 years or so? If you need spare parts, for example, Should you start doing business to distribute the company's products if you are a strategic partner? So those are the types of questions that the customers and partners will ask in terms of a company's performance. The last part is the government, the regulators, and the tax agencies. There are two obvious questions. One is the company behaving legally? And the other one is the company paying its fair share of taxes? That's the IRS coming into play. So those are the six entities. And then the question is, what do these people information want? But more importantly, where will they get and what exactly should be given? In the US, specifically, companies that allow the general public to their ownership shares, which in other terms, public companies have very clear and strict standards as to what information they need to release, in what format, etc. That's enforced by the Securities and Exchange Commission, in short, SEC. And they typically come up with reports that are published quarterly, which is 10Q, and there is an annual report that gets published, 10K, where a variety of information is disclosed. We are going to look at the financial statements in a second. Financial statements are big components of those, but in addition to that, there is managers or directors discussion about the company's risks, opportunities, and future prospects. So there is the quantitative or numerical component of it, as well as some qualitative and verbal components. Speaking of quantitative and numeric components, there are different financial statements that get issued in an annual report. There is the balance sheet, there is the income statement, statement of stockholders' equity, and cash flow statements. These filings also include commentary, as I mentioned, on company's management and other information to give perspective on what happened, what's happening, and what's going to happen in the future. We talked about, public companies. Small companies that are not public usually don't have to produce quote-unquote official standard financial statements, but it's in their benefit to run these, to make sure that they know the business they're in, they know what information is available around the company. So it's in their benefit, number one. Number two is typically small companies also get some type of investment from either, say, friends and family or other angel investors. Also, they may get some loans from bank loans, etc. So they will need this type of information as well from investors' standpoint. So these are the four financial statements. We are going to look at them briefly, and then in the upcoming weeks, we are going to look at them in detail. As I mentioned this week, we are going to look at the building blocks on how to build these statements, and the building blocks, the atoms or the molecules, are transactions that we are going to cover this week. So let's take a quick look at the balance sheet. It is the current state of the company. Basically, it has two pieces, which is assets. The definition of the asset is the economic resource the company will use in the future. And assets are typically funded by two sets. Let's take a look at the second part. Assets equals liabilities and equity. So the assets, which is the economic resource that the company will use in the future, is financed either by debt, which is liabilities, or by equity, which is either the owner's own contribution or investors' contribution as part of being basically a partner of the firm. So what are those assets? The assets are short-term assets. It can be cash, it can be inventory, accounts receivable, which is basically the money that other people owe to the firm. marketable securities if the company is investing some of the assets in other investments. And then there is a long-term part, which is the machinery, property, plant, equipment, servers, etc., and patents, and some also intangible assets such as patents and other intellectual property. So all those are assets. In order to finance those, you need to have either, as I mentioned, debt, which is a loan that a company can borrow. A bank loan is typically for smaller firms because they can't go to public markets. If it's a bigger firm that's traded in public markets, such as Apple or Google, then they can issue bonds. And issuing a bond is basically getting a loan from the public. And that bond will carry an interest that must be made every term, and at the end, when the bond matures, it's going to be paid back. A bank loan is similar in the sense that it's a loan, actually it's a liability, but it also it differs from the fact that it's not a bond. You directly deal with the bank itself. Those are the liabilities, and those are not the only liabilities. Typically, you have short-term liabilities. As an example, there is accounts payable. You buy certain things from your vendors, and you promise to pay them, and you typically pay them in 30 or 60 days or even 90 days. And that short period of time when you haven't paid your suppliers, that's accounts payable. Wages payable, on the other hand, is employees may be working for you for a time, and you typically pay on a bi-weekly basis, and there are times during that period the employees accrue certain wages, and just because of the timing perspective, if you haven't paid them yet, then that's wages payable. All those are short-term liabilities. And then there is the equity part, which is basically selling a partial ownership or the stake of the company. If you are a public entity, if you are trading in the public, you issue shares and you get the shareholders get a partial stake of the company. But the equity part is not only that. As the company operates and as the company makes income, some of the income is retained within the company. That is also a part of the equity section of the balance sheet. So that's our number one financial statement. Number two is the income statement, which basically summarizes the profit and loss. So at the top, you are going to see the revenue or the sales, and then you have cost of goods sold, which is if you are producing something, what's the cost of that production. The cost of goods sold is that part, and then you have gross profit, which is the difference between sales minus cost of goods sold, and then you have different operating expenses such as wages. Your machinery depreciates. There are supplies that you need to buy. If you are renting a place, rent comes there, and then there is the operating income, and then there are other parts, either revenue or expenses, not specifically related to operating income. You include those, and then after that you have taxes that you pay. So when you subtract from sales, cost of goods sold, and all the operating expenses, and then subtract the income taxes, you come up with the net income. If it's positive, obviously that means the operation is profitable. If it's negative, that means expenses exceed revenues, and as a result, the company is in a loss. The third type of financial statement is the statement of stockholders' equity, which shows the value of the company's equity over time. It has different parts. There is contributed capital, which is basically the owner's contribution to the company. And then there is retained earnings, which is practically all the net income that the company generates, minus any dividends they give out to shareholders. That's That's pretty much retained earnings. There is also something called treasury stock, which is the opposite of issuing the stock. So when the company, and these days companies typically buy their shares back, as a result of that, the opposite of issuing a stock is happening, and you get your shares back as a result of that, and that gives you total stockholders' equity. So contributed capital again has two main components: common stock at par value and additional paid-in capital. We are at the basic level of accounting, so what these are beyond the scope of this course. All you need to know is there are two of those parts. For those who are interested, typically common stock is issued at the par value, which is $1. But as you know, the shares typically sell above $1, and any difference between the $1 and the share sale of share price is captured under additional paid-in capital. So those are the main contributors, and the income statement shows the net income that also flows into the stockholders' equity under retained earnings as well. And the dividends, as I mentioned, is decreasing the stockholders' equity. The fourth and last one is cash flow statements. We are going to have 1 week to specifically look at cash flow statements, because cash is the ultimate measure of success. So we are going to dedicate 1 week for this. But in a nutshell, as you can see, we are tracking cash from 3 different sources. From operating activities, it will start with net income, and it's going to look at the different aspects of increase or decrease of short-term assets and liabilities. It's going to look at the depreciation and amortization, etc. Operating activities within the 3 sections will have the most, will give you the most important piece of information, because that's ultimately the cash that you cannot much manipulate. Net income, you can manipulate it to some degree if you have bad intentions, but cash is there. That's why it's the ultimate measure of success. Operating cash flow, again, it has 3 sections, as I mentioned. That's the day-to-day operations. There are 2 methods: direct method, which looks at cash collections and cash distributions. Indirect method is the one we are going to concentrate. We are going to start with the net income and then look at the non-cash items, such as changing in working capital, which is, in other words, changing in current assets and current liabilities. And then also there is investing cash flow, which basically look at capital investments. When you buy new machinery, when you sell old machinery, etc., those are captured in investing. And the third part of cash flow is financing cash flow, which is basically how are we financing these activities? Are we issuing stocks? Are we borrowing more money? That section of the cash flow is giving you that information. As I mentioned earlier, we are going to have 1 full week dedicated to the cash flow statement. And we are going to see in about 2 weeks, indirect method is more popular. It looks at the net income. It looks at the increase in depreciation, which is part of the net income, but typically not cash. And it looks at the changes in inventory, changes in accounts payable and accounts receivable. As a result of that, as I mentioned earlier, operating cash flow is a very crucial measure in company's financial health. In summary, balance sheet shows the assets, which is, again, the economic resources the company will use at the end of the period, and how those assets are financed, either through liabilities, through debt, or through equity, which is the partnership of the company. Income statement shows the income, the profitability, revenues, and expenses of the company, and cash flow statement shows cash in and outflows, and specifically how the cash flow is doing through operations, through investments, and through financing. and these three statements fit together, and you with these specific with these three statements plus the stockholders equity, you will have a very good picture of the health of the company. In the next videos, I'm going to show you how these financial statements are built. Specifically, we are going to look at the building blocks. We are going to start with how we are recording and journalizing transactions, and then we are going to use those journalized transactions to actually build these statements, so you know how these statements are built. And once you have that knowledge, you can critically look at this financial information. I hope this helps, and please continue watching the other videos I'll be posting this week. As I mentioned, we are going to have not only two sections of the videos, but three sections of the videos. I want to give you examples of how these transactions are journalized. Thank you.